Hunter, we're back and we are talking about more of our 2026 outlook. We've already had some developments so far in the year, so it's kind of going to be exciting to talk about some of those and what we're looking forward to. Now, last time we really talked about the AI space, being that huge mega trend that we're really watching, but there's a lot else under the surface that's playing into our kind of bullish thesis for equity markets this year. So I'm excited to get into that with you today.
Yeah, me too. Excited to continue walking through our 2026 outlook and addressing some of the biggest points that some have been going on for a long time, namely the Fed. We're going to talk about that briefly, where they're at, where we expect them to go, big developments with a newly appointed Fed chair who he saw us go through Senate confirmation and everything. It's not official yet. However, the decision has been made, and that all the implications that brings with that, as well as just general corporate earnings beyond what we talked about last time, beyond the AI companies, beyond your industrials, materials, as well as just the broad macro backdrop, which continues to change on a very daily basis.
Yeah, I know. I'm looking forward to that because we are very macro-driven investors. So looking at the global view and especially what's going on economically, not just on a company level basis, I think is really interesting. And of course, a huge piece of that is the Federal Reserve and where interest rates are headed. And we'll kind of start off with that. I think it's interesting when you take a step back. I mean, we were really on pause for most of 2025. And I think what's going to be interesting about 2026 is you're going to get a little bit of the repeat effect of that, where for most of the year in 2025, we were on pause, no change in rates, just Fed kind of kept, stepping along, leading us to the anticipation of the 3 rate cuts, those 25 basis point rate cuts that we got at the very end of the year. Now, I think we're going to see something kind of similar in 2026 where, markets anticipating roughly 2 rate cuts. Of course, it changes on a day-to-day basis, but we're sitting at that 3.5 to 3.75, 3.5%, 3 to 3.75% target range for the Fed funds rate, where the Fed is at right now. And, after a couple more cuts, you're really approaching that neutral level somewhere in that 3%, maybe a little bit above, a little bit below 3% level. And that's going to have some implications for broader markets. And I think what investors have to pay attention to right now is not necessarily, which meeting we're going to get that rate cut, because we've already seen one meeting go by, and of course no one was really expecting anything, so we didn't really see much reaction or much consternation in the analysis or decision to make a cut or not make a cut. But I think as we approach mid-year, you're going to get more intense discussions about, hey, is it finally appropriate to cut rates or not to?
Yeah, and that neutral rate, as depends on who you ask exactly, because that changes day to day. But along with that too is we started out projecting rate cuts maybe coming in April. That looks like, especially with the more based around Fed drama than actual underlying economic data, that expectation got shifted a little bit more towards mid-year. But to your point earlier, we were expecting 2025 rate cuts at the beginning of the year. And then that went on pause. And you hear about a 3 rate cut year and you don't think anything of it. Oh, that's a great year of rate cuts. Well, that was a great quarter of rate cuts, really. Right. And so not expecting these to get pushed to the end of the year, but kind of seeing them drifting a little bit later in the year, still targeting the first one around mid-year, maybe a little earlier than that. Will be interesting to see how that pans out, though.
Yeah, and I think it's not necessarily a concern for markets. I think participants were really worried in 2025, 2024 of, hey, when are we going to get these rate cuts, because they're, constricting the financial system where rates were elevated, and it was kind of inhibiting, some financial and monetary progress. And just kind of take a step back, I mean, the reason why the market favors lower rates is it makes it easier to hire because financing is cheaper. If companies are taking on debt, they can do so at lower interest rates, which means, as their cost of capital lowers, they're able to do a lot with that excess money that's not going towards debt repayment, or they're able to take on debt that they wouldn't have taken on in the first place. So that means they can either hire more people, they can expand via more capex, they can build more infrastructure, they can invest in new projects. A lot of things that they wouldn't be doing, under a higher interest rate scenario. Banks are going to be, lending more of their money out rather than parking it at the Fed. So this contributes, just taking the, the broader picture, contributes to our bullish thesis, because while you're going to see market participants get hung up on the timing and level of rate cuts for this year, the general trajectory remains downward, and I think that's the important piece to take. We're going to get somewhere probably between 1 and 3 rate cuts this year. We'll call 2 our base case, but as long as your trajectory is downward and you're not worried about that rate hike expectation. Mm-hmm. I mean, we saw what rate hikes do to markets in 2022, and that was a pretty dramatic pullback that was almost completely Fed and rate driven. And so the general trajectory being downward, I think, is what's really going to help equities this year, and something that is driving that bull thesis. So that just being the primary point, and of course, we got a new Fed chair as well, which is kind of throwing interesting dynamics into the conversation.
Yeah, I want to get there to the new Fed chair, but I do think it's important to take a step back and look at 22, really 23, 24, where the hikes drove the market down. Equities and bonds, mind you. It was one of the times that we saw a huge correlation in equities and bonds, because generally people's view, or at least did view, bonds as kind of your offset. But in 2022, they traded together downwards. But you saw what those rate hikes did, and then, continued high rates did to, we had that bank stress, I guess a couple years ago. And really what the most important rate cuts that we saw were those first few, really releasing all the pressure that had built up in the system.
Right.
Now we have it as a tailwind, but it's a lot less dramatic on companies like day-to-day existence. You're not worried about refinancing your debt twice as expensive as you had it previously, maybe not quite twice, but significantly higher than it was previously. Now it's a little more expensive, but we've not only had, it's not only a lower magnitude of change, but it's also you've had a few years to plan on it, to anticipate it. And so this will be a nice tailwind, but 1 or 2, even 3 rate cuts from here aren't going to be super dramatic changes in companies' day-to-day lives, but it will make a big difference in the longer term macro picture.
Right. And I think, when you're talking about, the burden of financing on companies, it's also important to acknowledge that we have more and more of, especially in the private markets, but also in public markets to some extent, private credit playing more and more of a role in company financing. And most of that is floating rate debt. So it is, for those companies especially, is an immediate benefit whenever you have rate cuts. Typically, they're operating on SOFR, your overnight lending rate, plus some kind of spread. Well, as soon as the Fed funds target lowers, that SOFR rate's going to lower as well, which provides some immediate relief to those businesses. And I don't want to get too much into the financing piece, because we've talked about this on other podcasts along with private credit, but I think that's going to be a dynamic to watch. But I do want to talk a minute about the new Fed chairman, who won't be coming in until very likely May, when Jerome Powell finishes his term. But Kevin Warsh has been, dubbed as the next Fed chairman. Let's kind of break that down and what that means for markets, at least as far as what we know right now.
Yeah, and I think it's a really interesting choice. Markets have seemed to have mixed feelings. It's hard to read too deep into what the markets are saying on any given day and assign it all to, Trump's pick on the next Fed chairman. But this is a guy who does, obviously on some level, aligns with the current administration's, dovish, aka towards rate cut bias. However, he's been historically fairly hawkish or against quantitative easing or the Fed injecting money directly into the money supply, generally through banks and buying treasuries and such. So, which is a little bit different than what a lot of people were anticipating, and I think will actually could pay some dividends in the fact that we're as far as the curve steepening is concerned, because injecting cash into the economy immediately translates into inflation way more than rate cuts do. At least in my opinion, it's a very direct, you put cash in someone's pocket, they're going to go spend it.
Exactly.
If you reduce the rate on, say they have a floating rate mortgage, they're not exactly going to see that savings as a cash injection and immediately go spend it. It's going to be a different kind of mentality that plays out there. So generally when you see quantitative easing, it's that money straight into the economy, which again, boosting inflation, which is what the Fed doesn't want to do right now. On the flip side, you have to make sure liquidity remains, in a window that makes sense for what we're trying to achieve, good economy. Banks can go lend without worrying about liquidity issues, but also you don't want excess liquidity in the system.
Yeah, I think if you could describe him as an anti-inflation dove, that might be somewhat appropriate.
That's
just
fair.
Because he's looking for lower rates, which operate on a longer lag than QE, exactly to the point that you're making. QE is more of an immediate cash injection, whereas a lowering of rates, it takes time for that to trickle through the system because companies aren't going to immediately announce a new CapEx project. They're not going to immediately, go out and pull out a new loan, bringing more dollars into the economy. They're not going to do all these things as quickly as, hey, the Fed's going to buy a bunch of bonds and all of a sudden you have this cash injection into the economy. So just reiterating what you said, because I think it's a great point. And it's going to be interesting to see because he kind of wants this regime change, this focus on the Fed having a lower balance sheet, to your point, not buying as many bonds and holding those on their balance sheet. He really wants to steer away from that aspect of the Fed. But that's kind of been ingrained into Fed calculus and Fed operations for quite a while at this point. So him convincing the other governors and presidents to kind of move away from that, it's going to take some time. So his entrance into the Fed, or I should say re-entrance, he was a Fed governor before. It's going to take some time for him to have that kind of influence. But I think markets are relatively neutral, but Wall Street appreciates that he's still a little bit more independent from the federal administration or the Trump administration than maybe some of the other picks would have been, which I think the market appreciates. They want the Fed to remain relatively independent. And not up to the choices or decisions of the president. So I think from that respect, he's a positive in the market's eye.
Yeah, and briefly before we shift gears and start talking about companies and sectors and their earnings growth that we're expecting for next year, I want to just take a moment and talk about something you kind of touched on is the inflation picture, because you mentioned it operates with a lag, and so we're sitting still above the Fed's target. However, just looking forward, just briefly, it looks like there's a lot of things that are going to start rolling off. We've seen shelter inflation really turn over, and we're starting to see that downward trajectory, which is helping that services inflation, as well as goods inflation due to the tariffs that were announced in April of last year. Those are about to kind of roll off because that was a one-time step change price increase. But that was a one-time price increase. So after 12 months, you're not going to see that in the inflation data anymore. And your year-over-year percentage change is going to come back down into, much more representative of what we're facing for the past, 6-9 months than that one-time price increase. Yes, prices are still high, but inflation being the rate of change in prices, they're not increasing that much. And, we should see us much closer to the Fed's target in the coming months. And so I think a lot of the Fed calculus is predicated on let's plan for that, make sure it happens and don't get ahead of our skis and, count our chickens before they hatch. But they're making plans expecting that to roll off in the next few months. So that's pretty encouraging going forwards.
Yeah, I think the inflation dynamic is looking fairly positive. Of course, there's a lot of underlying factors, and we'll probably have to do an entire new podcast just on inflation and what we're seeing there. And I think the broader trend when it comes to the Fed too and inflation is that we are going to be in a data dependent kind of nature for the Fed over this year. And to your point, as inflation kind of cools, especially towards the latter half of the year, assuming that the job market remains relatively stable, if inflation comes down in the latter half of the year, it's going to give them more leeway to cut rates at that point, which kind of falls in line with what our current thesis is.
Yeah.
Now, kind of moving on, another big factor for our bull case. So we talked about the Fed, the downward trajectory of rates being part of that bull thesis. Another one is earnings growth. The beautiful thing about what we've seen in the markets over the past few years and what we anticipate and analysts across Wall Street anticipate this year is pretty substantial earnings growth. So I kind of want to take a minute to kind of break down some of that. But what most people are expecting is somewhere in that kind of low double-digit range for earnings growth, 12 to 15%. Which is very substantial, and that would be a great result if we're sitting at the end of 2026 and we saw somewhere between 12 and 15% earnings growth for the S&P 500.
Yeah, and it's always hard to argue with earnings growth if the market's going up. If you have multiple expansion, there are ways to, arguments to make for and against why it deserves a higher price now. But earnings growth at the end of the day is very tangible. You can point to it, say, hey, earnings went up 12%. The company should hopefully do pretty close to that, depending on multiple expansion contraction, but it's a very tangible, solid, driver of growth. And, being what I would loosely define as GARP investors generally, growth at a reasonable price, seeing that growth carry forward is a really encouraging thing in finding the right areas of the economy where we expect that to be, because it's not everywhere, but even just broad S&P 500 is very encouraging to see low to mid double digit growth expectations.
Yeah, no, completely agree. And I want to make a point that, and you mentioned multiples. A lot of people have complained about the markets over the last few years being really expensive. Hey, the PE ratio is higher than it traditionally has been historically, which, maybe warrants some kind of, sell-off or re-rating. Well, the good thing about, the double-digit earnings growth is you could still have, if you have 15% earnings growth and you move from, we're right around somewhere 22, 23 PE on the S&P 500. If you bring that down a point and call it, somewhere in that 21 to 22 range, you can still have a double-digit year for the S&P 500 with 15% earnings growth. So, as long as that, denominator piece, the earnings piece, is growing at that rate, that's what you really want to see. We look at that as much healthier expansion than, your earnings are flat, but the multiple you're paying is higher. That can drive the market upwards, but it's not as healthy as, hey, you've got that strong underlying earnings growth that's leading to that price performance.
Yeah, back to the GARP thing, that would be a less reasonable price for your earnings growth. But, almost compounding is there's more of an argument to hold ratios, price to earnings ratios, stable if your earnings growth is higher.
Right.
Because higher earnings growth can command a higher PE multiple. Not even advocating for higher PEs, but if they were just to stay the same, then that's a great driver of that argument to abate some of the concern that they're a little high historically. But I think we've done a pretty good job in previous podcasts of addressing why historically on the S&P 500 isn't really apples to apples all the time. And then going forward with that too, something that we called out in our last episode, specifically in AI, but also applying it to just the broader S&P 500's broader stock universe in general, is not only that growth, but also positive, good free cash flow, as well as low debt. Because depending on which company, and it's very company by company, some companies are taking a lot of debt to grow their earnings or to capture market share or whatever it is. Some can do it based out of cash flow, and that's always a much safer way to do things is if you can pay for them right now instead of taking on debt to pay for them later.
Exactly. And I think, and what you're bringing us back to is, how we're looking as far as our investment thesis and which companies we're selecting here is we think maintaining high quality in your positions is very important right now. We've seen in 23, 24, you could kind of throw your dart at a dartboard in the S&P 500 and come out relatively okay, especially if you were exposed to Mag 7 or tech. And you're getting broader discrepancy now within those companies and how their earnings trajectories are looking. So maintaining a high quality bias, I think, is going to be important. Now, another piece of what I think is going to drive stocks this year are buyback authorizations. So we're seeing essentially peak buyback authorizations for S&P 500 companies, with about roughly 1.1 trillion dollars expected in buybacks this year. So companies using, the cash that they generate to buy back their own stock, thus removing some shares from circulation, increasing that stock price. That's a great way to give money back to shareholders as opposed to issuing a dividend or some kind of cash payment. And so you're seeing those buyback authorizations really surge because that, to your point, cash flow generation has been strong. So companies want to return that to shareholders. And in this case, you're not having to incur that via, ordinary income through a dividend or something like that. You can promote the stock price by, buying back your shares.
Yeah, we get a question on that every once in a while. Why do companies, some favor buybacks over dividends? Dividends can be seen as more direct payments. They are more direct payments, but they're so direct that they're taxable events, whereas a stock buyback is just appreciation of that stock you're holding. So it'll translate into hopefully a long-term capital gain, but it's not a direct cash payment, which is always nice, especially in this time of year.
Yeah, I always prefer buybacks just because it allows the investor to determine when they want to be taxed on that return versus that being up to the corporation. So, of course, you're still subject to the whims of the market whenever it comes to price changes on that equity share, but that would certainly be my preference.
Yeah. And then going into kind of the final point that we made about corporate America and the broad market is deregulation taxes. This is something that I've seen way more articles on this year than I have since I've been, in the markets really and following it, is the expectation of not only for companies, but also for consumers, higher tax refunds, lower tax burdens. And that's driven through, and for companies especially, that's driven through not only the direct taxes, but just operational efficiencies. That 10-to-1 rule that they instituted of for every new regulation, you need to get rid of 10 old ones. Well, the operational cost of those, call it net 9 regulations is immense to companies. And that's oftentimes not directly seen anywhere, just how expensive all of this is just to keep compliance with. That's not only the actions you must take to be compliant, but all of the people you need to hire to determine how to be compliant.
Yeah, no, exactly. And you have to take this with a grain of salt because it was a government study, but there's a government analysis that showed that we could add, somewhere between 30 to 50 basis points to GDP just this year if, deregulation really progresses the way that they intend it to. And that's because there is a significant regulatory burden on corporations, on private companies, that if you remove that obstacle to corporate growth, to, hiring, to capital projects, then you get more growth within the economy. So ideally, the administration would, roll back some regulations, get out of the way of the free market to some extent, of course, to a healthy extent. But that could mean, better economic activity this year and years into the future, because the benefit of rolling back regulations is not only is it beneficial this year, but it's beneficial for every year to come as long as they're not reinstated later in time. So that's a huge benefit. You also mentioned, higher tax refunds. I think that's something that's really going to impact the consumer. It's going to impact investors, especially the retail investor. Whenever you get into, call it that March, April timeframe, whenever those tax refunds start to hit, because of the new tax code, because of the extension of the Trump tax cuts from his previous term. you're going to see huge refunds hit the market, which a lot of that's going to flow into new purchases. It's going to pay down debt. It's going to go into investing in the stock market. So that's a trend that I'm certainly looking forward to just in a couple of months here.
Yeah. And one quick note on something you mentioned about the deregulation, doing it responsibly is, I just want to call out arguing for deregulation or the 10-to-1 rule or however you want to call it. It doesn't have to necessarily be lighter regulation, but if you can take 10 rules and consolidate them into one, just the removing the complexity of it is going to save huge amounts of personnel hours in decoding what you need to actually do. And so there's savings in time and money even without changing at the end of the day what you want companies to do. And so I think, and that is, part of the push, at least, is just the efficiency of it. And so I think seeing that would be really encouraging to companies, but also just for, like you said, GDP reasons in general. And then one other thing that you touched on earlier, which kind of leads us into the final section of this, is increased market breadth. And we're talking about throwing a dart at the dartboard in previous years, and you kind of came out okay. As long as that dart landed on one of the Magnificent Seven names, you're pretty good. But even so far this year, we've seen, and last year to an extent, saw this kind of bifurcation in the Mag 7. Some of those turning into kind of giving back some of their gains, others continuing to lead the way, new members of, kind of the new Mag 7, as it were, stepping up to take their place. You want to elaborate on that?
Yeah, and I think this kind of, as we kind of conclude here and wrap it up through this conversation, the two things that we mentioned come into play here. So your combination of lower interest rates and lower regulation really feed into greater breadth within the economy, and these are going to benefit those smaller companies in particular. Larger corporations, they are more flexible in terms of their financing, so they traditionally get cheaper financing, and they have the lobbying power and greater legal power that allows them to avoid some of the more stringent regulations, whereas the smaller companies don't necessarily have those benefits. So now we're getting that combination of deregulation and lower interest rates that I think is going to contribute to market breadth, which we haven't really seen in the past few years. To your point, it was really Mag 7, 23, 24, even a lot in 25. And we're already seeing, especially late second half of 25 and already this year, seeing that market breadth expand. You're getting more of those small cap companies, more of your small and medium sized companies performing well. And I think you do have to be selective in that space. Our preference, of course, is for positive cash flow, positive earnings, reasonably low debt, because you want to keep that quality high, like we mentioned earlier. But I think that's going to be a growing dynamic in 2026 and something that we have, allocated to in our portfolios to benefit from.
Exactly, and I think you've already begun to see a lot of that, those quality companies being rewarded, like we mentioned in the AI space, but also throughout the rest of the economy. Well, I'm very excited for our next episode. Is going to be part 3 in the final wrap up of our 2026 outlook, as well as some exciting new things coming down the pipe. There's a lot going on in the markets right now, so I'm excited for those future episodes to start unpacking it.
Absolutely, it's going to be exciting, and stay tuned for our next episode. Can't wait to go through it with you, Hunter.
Great, thanks, Victor.